There's a quiet revolution going on in the railroad industry. Over the last couple of years, we've seen CSX and Union Pacific embrace what's known as precision railroading. It's an ultra-efficient way to route trains pioneered by the late, great Hunter Harrison, and his vision keeps spreading. Today, Norfolk Southern, the other big East Coast rail, aside from CSX, held an analyst meeting where the company laid out a bold and terrific vision to boost its productivity and efficiency. In other words, they're getting in on the precision railroading game, too. Norfolk Southern wants to bring its operating ratio, the ratio of expenses to net sales, down from 65% to 60% by 2021. At the same time, the company told a good story about the broader economic environment, which is why the stock surged $5.49 or 3.2% today on a ho-hum day. And that's on top of a massive rally since the December lows, fueled in part by the terrific quarter the company reported late last month. So let's dig in with James Squires. He's the chairman and CEO of Norfolk Southern. Learn more about his plans for this great American railroad. Mr. Squires, welcome back to Mad Money.
Thanks for having me on the show, Jim.
All right, well, this was a dramatic meeting, and I want, Jim, for you to explain to our viewers what the message is you're trying to convey about reimagining your great railroad.
Well, Jim, I want to start by saying how proud I am of our employees and what they have accomplished the last few years. We started out in 2015 with a plan to get to an operating ratio below 65 by 2020. Last year, we closed out at 65.4, so nearly there in 2018. We just announced today our plan to get to a 60 operating ratio by 2021. And that will be through a combination of precision railroading practices that will help us bring down cost and growth in the top line.
Well, but yeah, let me tell you my confusion. All right, when I first met you, the stock was about 66. Now it's at 177. You have returned a gigantic amount of money to shareholders. You just mentioned the 740 basis point decline in expenses. What I'm confused about is why did you need to even switch to precision railroading? Maybe you can explain it to me, because as far as I was concerned, you were pretty precise.
Well, Jim, we are proud of what we've accomplished, and we've done a lot, but we can do more. And that's our commitment to our shareholders, to get the operating ratio down even lower through that combination of precision railroading and through continued growth in the top line. We're in a great growth environment, and we want to be sure to capitalize on that in top line growth as well.
So will there be fewer locomotives, better placement of where they are, more on-time trains? Is that what it figures in?
Yes, precision railroading is all about utilizing employees, utilizing locomotives, utilizing freight cars, utilizing all railroad assets as efficiently as possible. So that's a big focus in our new plan. And that's a big contributor to the lower operating ratio by 2021. But we're also focused on growth. We remain in a great growth environment. We think we have both secular and cyclical growth opportunities ahead.
I'm so glad you mentioned that, because there's a lot of pervasive gloom on Wall Street. One of it is that there are a lot of people talking about we're going to have a recession this year. Others are saying there's going to be a dramatic slowdown. To me, I look at what you're projecting, and I see a good year. And not only that, but some of your lines, like automotive, you're getting more bullish on.
When we look at both the macro indicators and when we do our channel checks, we feel good about the current business environment, and we do think we have growth opportunities with our customers this year. So overall, the climate looks good to us.
Now, you had a record revenue number for Intermodal, and maybe you can explain to people why this is such a profitable business, both for you but also for your clients.
Well, we had a great year in Intermodal in 2018, and that was on the heels of a good year in 2017 as well. So Intermodal has been our growth engine for quite some time, and we expect it to continue to be. Trucking remains tight. It's difficult to hire truck drivers, and that's our main form of competition in the intermodal business. We have terrific channel partners in intermodal, and so we remain bullish on intermodal. Margins have improved. It's just a great space to be in, and we have a terrific franchise.
Now, a couple of the analysts, and I know that the meeting just ended, but they've already come out. I'll just quote them. Credit Suisse says your targets are aggressive. Deutsche Bank says they are ambitious. Both of them a little skeptical that you can reach these levels in such a short period of time. What do you tell the skeptics?
Well, this is an aggressive plan. But it's an achievable plan. We have a great deal of confidence we can get there with the backing of our employees and the hard work of everybody on the railroad out there. It's a plan that relies on precision railroading to drive the cost reductions, And it's a plan that relies on the great Norfolk Southern franchise to generate the growth and get us to that 60 operating ratio by 2020.
Now, when I read through the presentation, it was really terrific. One of your people did talk about how you had precision railroading going in one area, in one hump, so to speak. It's not new to you, but it just seems like it's now going to spread along your gigantic network.
That's true. We really began this journey last year. We started doing something we call clean sheeting, which is essentially re-engineering operations in the field. You just take a look at everything you're doing, you try to get the waste out of it. We're working with our customers, bringing them into this so that it is a collaborative process with our customers. And we've just been picking up speed. We hit an inflection point with it late last year, and we've gained momentum in 2019. So we're hitting on all cylinders with the precision railroading. At the same time, we're continuing to drive growth in the top line.
All right, now, I deal with a lot of the utilities that happen to be in your area because a lot of straight shooting people, and they want to do the right thing for the environment. They're deeply committed to that. I know there's cynics out there who say that they're not, but they are. And yet I saw a big increase in coal. Where is that coal going?
Well, we have a diversified coal franchise. We send coal to U.S. utilities. We also help our customers export coal overseas. The U.S.-based coals are primarily utilities, as mentioned, but also for making steel, metallurgical coal going to our steel manufacturing customers. The coal going overseas is a combination of metallurgical coal and steam coal as well.
Now, there's a huge renaissance in this country involving chemicals, natural gas, oil. You figure in, and I noticed that Marcellus, Utica, we visited Marcellus, Utica years ago, and there really wasn't that much happening. If I go there now, would I discover a natural gas renaissance there?
You would, absolutely, and that's a big contributor to our industrial products franchise as well. We handle a lot of commodities. And those are things like sand headed impound that's used in the Marcellus region for fracking. We also handle a lot of chemicals that are manufactured in our service territory or beyond that are beneficiaries of cheap and abundant natural gas.
Wow. Well, look, Jim, I want to congratulate you. Again, I mean, I was taken aback because you're one of the best. You run one of the best performing stocks since we started the show. But obviously, you're not going to rest on your laurels. Congratulations to Jim Squires and the new plan, Chairman CEO of Norfolk Southern, where they're going to make even more money for shareholders. Mad Money's back after the break. Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.